On April 16th, before the opening of the Chinese stock market, the official website of the White House in the United States suddenly announced that due to China's retaliatory measures, Chinese goods exported to the United States now face tariffs as high as 245%. Suddenly, the news spread across the internet, and many people thought that the United States had raised the latest tariffs from 145% to 245%. Market panic sentiment clearly spread. After the opening, both the A-share and Hong Kong stock markets opened lower and continued to decline during the trading session. However, in fact, this 245% is not a new move. Instead, it is the upper limit of the tax rate for a certain commodity calculated based on a series of past tariff policies. Specifically, 245% only applies to the single category of syringes and needles. Why are such high tariffs imposed on syringes and needles? This is mainly a legacy of the Biden administration. In September last year, in the final measures of the Section 301 tariffs on China, the Office of the United States Trade Representative raised the tariffs on medical gloves, syringes, needles, etc. to 100%. So, when combined with the latest tariffs, the tariff on syringes and needles has reached 245%. There are also some other categories with relatively high tariffs. For example, the tariff on lithium-ion batteries is 173%, and that on wool sweaters is 169%. Some categories have relatively lower tariff rates. For instance, the tariff on semiconductors is 70%, and that on mobile phones and laptops is 20%. And children's books are directly tax-free. This time, the White House put 245% in the announcement, shouting out a large number, which actually reveals a sense of bluff. According to the Chinese side, when the tariff exceeds 50%, many commodities will have no profit, meaning selling one unit will result in a loss. Now, even if the tax increase is exaggerated to 200% or even 1000%, it has no practical significance and will only remain as a number with no possibility of implementation. And the Chinese side's strategy has been clearly stated before. If the US side continues to impose additional tariffs on Chinese goods exported to the US, the Chinese side will ignore it. Although the 245% tariff turned out to be a false alarm, the stock market did not come down because of it. What may have caused market panic is perhaps this more crucial piece of news. After the US stock market closed, Nvidia suddenly disclosed a document which roughly stated that the Trump administration requires a license for the export of H20 chips to China. And the matter doesn't end there. Nvidia plans to set aside $5.5 billion in costs related to the H20 production line. It's equivalent to saying that Nvidia had previously concealed the strictness of US restrictions on chip exports to China. It should be known that H20 is the main AI chip that Nvidia sells in China. It is already a castrated version and became popular after H100 and A100 were banned. Before this, a series of events had indicated that Nvidia had reached an agreement with the US government not to restrict H20. But the latest event shows that H20 from Nvidia also needs to apply for a license, which actually means a disguised restriction on exports. This has exceeded market expectations. Overall, the confrontation between China and the US shows a trend of further escalation. The A-share market has been tossed around by these successive news. Although the Shanghai Composite Index continued to rise tenaciously by 0.26%, more than 4,300 stocks in the entire market declined, and the median of stock price increases and decreases was 1.71%. Stocks can decline, but the Shanghai Composite Index cannot turn red. Upholding this principle, it can be seen that near the end of the trading session, the traces of the national team entering the market to support the market are very obvious. On that day, the trading volumes of many Shanghai Shenzhen 300 ETFs increased abnormally, coupled with the fact that some large-scale funds were instructed by the window not to sell stocks net. The chips of some large-cap stocks may have been directly taken over by the national team. This led to a situation where near the end of the trading session, the trends of many completely unrelated large-cap stocks were highly similar, and their stock prices rose synchronously. For example, Avik Optoelectronics, Ping An of China, and Quaicao Mutai, One is in military electronics, one is in insurance, and the other is in liquor. Their fundamentals are completely different, but their trends before the closing were highly similar. From this, it can also be seen that the national team generally mainly operates on the Shanghai, Shenzhen 300 and Shanghai 50 indices. They will not touch a large number of small cap stocks and high valuation stocks. Currently, it is not clear how long this market support task will last, but obviously, this is not a long-term solution. Once the bottom supporting operation ends, the market will correct the part of the previous rise. And since the Hong Kong stock market does not have the protection of the national team, it has fallen more. The Hang Seng Index dropped by 2%, and the Hang Seng Tech Index plummeted by 3.9%. At the same time, although the US stock market had not opened, US stock futures also dropped significantly. According to the latest news, S&P Global Ratings issued a warning that if anything happens in the future that worsens the US fiscal situation, it may downgrade the US credit rating by one more level from the current A+. It is worth noting that when S&P Global Ratings downgraded the US rating in 2011, it once triggered a large-scale sell-off in the US stock market. In addition, the European credit rating agency Scope also warned that if a protracted trade war weakens the world's long-term trust in the US dollar, or if Trump implements more extreme measures such as capital controls, the US credit rating may be downgraded. On April 16th, due to concerns about the expansion of the trade war, the US dollar plunged again. The US dollar index, which measures the value of the US dollar against 6 major currencies, dropped by more than 0.8% during the trading session and touched a low of 99.35 on that day, approaching the 3-year low set last Friday. The latest survey of global fund managers by Bank of America shows that bearish bets on the US dollar in April climbed to the highest level in nearly 19 years. At the same time, the euro suddenly made a comeback. The exchange rate of the euro against the US dollar appreciated from once approaching 1 to 1 to 1.13 to 1. While the euro appreciated against the US dollar, it also appreciated significantly against the Chinese yuan. Compared with February this year, 1 euro can exchange for nearly 1 more yuan, rising from around 7.39 to around 8.37. At the same time, the euro's exchange rate against the British pound, Canadian dollar, and Australian dollar also appreciated significantly. It can be said that except for a few traditional safe haven currencies such as the Japanese yen and Swiss franc, the euro has appreciated against most currencies. So, here comes the question. Why has the euro suddenly soared? We know that since Trump initiated the tariff war, the United States has experienced a triple whammy of declines in stocks, bonds, and the exchange rate. A large amount of risk-averse funds have flowed out of the United States. Some of these funds have been invested in gold, while others have flowed back into the bond markets of their home countries. Judging from the current situation, the largest portion of these funds should have flowed into euro-denominated assets. Why have these funds chosen the euro? The euro is the world's second largest currency and is widely recognized as one of the hard currencies. As of the third quarter of 2024, the share of the US dollar in global foreign exchange reserves had dropped to 57.4%, compared to a high of 66% in 2015. The share of the euro, on the other hand, had increased to around 20%, which is almost equivalent to the combined share of all other currencies except the US dollar and the euro. In terms of the market share of global payment currencies, the US dollar accounts for 47%, and the euro is close to 23%. Although the euro is not as dominant as the US dollar, it still has a significant advantage over other currencies. Although there are also tariff frictions between the United States and the European Union, and there is even a possibility of these frictions escalating, with China taking the brunt, the pressure on Europe is much smaller. In addition, the German government announced a plan to invest several hundred billion euros in national defense and infrastructure construction. The credit spreads of the national bonds of peripheral countries such as Italy and Spain have basically returned to normal, and the era of negative interest rates in the Eurozone has ended. All these factors have made the euro stronger and improved its creditworthiness. So, Will the euro continue to appreciate? It's hard to say. It depends on Trump's next moves and the relationship between Europe and the United States. As long as the concerns persist, weakening the market's demand for US assets and causing funds to continue flowing out, the euro is still likely to continue appreciating. In China, the outflow of funds has always been a sensitive topic, while in the United States, it seemingly hasn't been an issue because of the country's sufficient confidence. However, the situation has changed now. After the pandemic, global funds poured into US Treasury bonds and the US stock market. While creating a long bull market in the US market, this also sowed the seeds of risk. As former Treasury Secretary Henry Paulson predicted, once the relationship between the United States and the world changes, and both US Treasury bonds and the US stock market are in a vulnerable period, for example, when US Treasury bonds mature, the possibility of a high valuation crisis in the US stock market will increase significantly. Currently, the only thing that cannot be determined is where the trigger point lies. However, it should be noted that recently, the yield premium of US junk bonds has broken through for 150 basis points. This is the largest increase in the yield spread since the COVID-19 pandemic in 2020, exceeding the level during the Silicon Valley Bank crisis in March 2023. Many people don't quite understand what the yield premium of US junk bonds means. Here's an explanation. The yield premium of US junk bonds, also known as the junk bond interest rate spread, refers to the difference between the yield of US junk bonds and the yield of US Treasury bonds of the same maturity. This indicator reflects the additional return compensation that investors require for bearing the credit risk of junk bonds. For example, if the yield of a 3-year US Treasury bond is 3.95% and the yield premium of 3-year junk bonds reaches 450 basis points, it means that the average yield of these junk bonds has reached 8.45%. If an enterprise wants to issue junk bonds, it needs to offer an annual interest rate of 8.45% to have a chance of selling them. In the current global economic situation, how many enterprises can afford to pay such a high interest rate? For example, the yield of the latest 5-year bonds issued by Ford Motor is as high as 9.2%, with a premium of 580 basis points compared to the bonds of the same maturity, reaching a new high since 2009. The bonds issued by Ford are typical junk bonds. This yield is reminiscent of the yield of Evergrande's bonds on the eve of China's real estate crisis. Perhaps some people will ask, why does Ford issue junk bonds? Can't it issue normal bonds? Whether an enterprise's bonds are considered junk is determined by its operating and financial conditions and is a judgment given by the market. For excellent enterprises, the bond interest rate will naturally be lower. For enterprises with poor financial conditions and a bleak outlook to sell their bonds, they can only increase the yield. Now, the overall yield of US junk bonds has soared, and the difference from the yield of Treasury bonds of the same maturity has reached 450 basis points, which is already a dangerous signal. Generally, it is believed that when this difference reaches 500 basis points, the Federal Reserve must take action. Otherwise, a financial crisis will ensue, because the enterprises that issue junk bonds are already in a not so good situation, and when they encounter such a rare global trade shock, they are very likely to quickly become insolvent and default on their debts. When investors sense that something is wrong, they will uniformly sell junk bonds, which will further drive up the yield of junk bonds and further increase the financing costs of these enterprises, pushing them to the brink. We know that financial crises often start in this way, with the soaring yield of junk bonds toppling the first domino. First, the vulnerable enterprises will collapse, causing bond and stock prices to plummet. Then, medium-level enterprises will follow suit. And finally, even excellent enterprises will find it difficult to withstand the test. So, does the official side have any countermeasures? Of course. For example, the Federal Reserve can provide liquidity by cutting interest rates, stopping the reduction of its balance sheet, or even expanding its balance sheet to avoid a full-scale default of junk bonds and the outbreak of a financial crisis. The Federal Reserve's next interest rate meeting will be held from May 6 to 7, 2025. If the risk of junk bonds continues to soar in the coming period and the US Treasury bond market continues to experience a selling spree, the Federal Reserve may reverse its policy direction and announce interest rate cuts, stop reducing its balance sheet, or even expand it. And this is exactly what Trump wants. But no one knows which will come first, the interest rate cut or the collapse.